All right, so let's talk about 2026. The market right now, it's a total paradox, isn't it? You've got this AI-fueled rocket ship blasting off on one side, but then, on the other, you have some of the smartest investors on the planet, and they're just building this massive fortress of cash. It's hype versus caution, plain and simple. So, what are we supposed to do? Let's break it down.
And this slide right here lays it all out. On the one hand, you've got this incredible AI-fueled boom. New York Life Investments calls it a virtuous cycle, and it feels powerful. But then you look at the other side, and you see this giant mountain of cash just sitting there, with legendary investors basically saying, nope, not playing at these prices. One of these signals has to be wrong, right?
So what is really going on here? Are we looking at a super strong, resilient market that's just getting started, or is it dangerously overvalued and setting us all up for a major, major correction? We're about to dig into both sides of this argument. And hey, stick with me because at the end, we're going to talk about a timeless strategy to cut right through all this noise. Okay, first up, let's talk about the bulls. Let's really dig into why so many investors are feeling optimistic and going risk on. Honestly, there's a pretty powerful mix of things happening right now that are creating what feels, well, like a pretty perfect storm for stocks. So, according to the analysis from New York Life Investments, the big picture actually looks really constructive. I mean, think about it. The Fed is hinting at easier money, we're seeing some pro-growth policies coming down the pipeline, and corporate profits, they're holding up surprisingly well. But the real engine here, the thing that's really driving all this optimism, yeah, you guessed it, it is all about AI. And this is where it gets really interesting. This slide shows what they call the AI virtuous cycle. It's a feedback loop. So, companies are pulling in strong earnings, which lets them spend even more money. We're talking huge capital expenditures on AI. The market sees this, absolutely loves it, and rewards those companies with higher stock prices. And what does that do? It gives them access to even more cheap capital to start the cycle all over again. It's this powerful, self-reinforcing loop, and it is driving a massive chunk of the market's returns right now. Okay, that all sounds pretty great. But now, let's flip the coin completely. Because while a lot of Wall Street is popping champagne for the AI boom, the guy who inherited the mantle from the Oracle of Omaha, well, he's sending a very, very different and much quieter warning. Just look at this number for a second. $373.3 billion. That is the size of the cash pile Berkshire Hathaway was sitting on at the end of 2025. You've got Greg Abel, Warren Buffett's hand-picked successor, in charge of the largest corporate cash reserve in history, and he's basically chosen to do nothing with it.
And that's why this cash pile matters so much. As one analyst put it, and I think this nails it, this isn't just caution, it's a warning. Abel isn't just sitting on the sidelines because he's scared. He's waiting because, from his point of view, the market simply doesn't offer enough value to put the world's biggest pile of dry powder to work. Not yet.
And here's the hard data that's probably keeping him up at night. You've got the Buffett indicator, which basically asks, is the stock market bigger than the entire U.S. economy? And it's sitting at 200%. That's a level Buffett himself has flagged as being deep in the danger zone. Then there's the Shiller PE ratio, which is a way of looking at valuation over the long haul. It's at 36. Its historical average, about 17. So, yeah, more than double. These indicators aren't just flashing yellow, they are screaming red.
And you know, it's not just about the price tag. Buried in Greg Abel's very first shareholder letter was this really subtle, but I think incredibly powerful line. Some analysts are reading this as a quiet shot across the bow of the whole AI sector. It's like, while everyone else is in this massive gold rush, Berkshire seems to be worried about the long-term reputational risks that maybe others are just too excited to even see right now.
So, what happens when a red-hot market, absolutely swimming in borrowed money, hits an unexpected speed bump? Well, we don't have to guess. We just have to look at what happened to the crypto market back in October of 2025. It is a perfect and pretty brutal case study in just how fast speculative excess can get cleansed from the system.
Now, here's the crucial thing to understand from this. The trigger for the crash, it wasn't even a crypto-specific problem. It was a global geo-economic shock. But the reaction, that tells the whole story. The S&P 500, it took a hit for sure, but then it started to recover. But the crypto market, which was way more speculative and highly leveraged, it didn't just fall, it cascaded downwards for weeks as all of that hidden debt was forced out into the open. This is what happens when hype slams into reality. And that whole painful process, it really unfolded in two clear phases. First, you had the initial liquidation shock. That's when all the traders with way too much leverage got margin called and were forced to sell, no matter the price. But that was just the start. That was followed by a slower, more grinding deleveraging cycle, as the entire system started reducing its risk, which put this sustained, heavy pressure on prices for weeks.
And this chart right here just shows the brutal aftermath. We're looking at open interest in Bitcoin derivatives, which is basically a good way to measure how much borrowed money is sloshing around in the system. And look at that. It was cut in half. It went from a peak of $45 billion all the way down to $22 billion. Poof, just like that. More than $20 billion of purely speculative capital just vanished, basically resetting the entire market back a full year.
Okay, so we have this intense tug of war, right? You've got this wild AI hype on one side and this extreme, deep-seated caution on the other. So what is a regular investor supposed to do with all this? Well, the answer isn't about trying to be a genius and perfectly time the market. It's about adopting a timeless strategy that actually works no matter which way the market breaks.
And for that, let's go all the way back to the basics, to the man who literally wrote the book on value investing, Benjamin Graham. He came up with this idea called dollar cost averaging, or DCA. And the concept is just brilliantly simple. You invest the exact same amount of money at regular intervals, say every month, no matter what the market is doing. This simple discipline automatically forces you to buy more shares when prices are low and fewer shares when they're high. And the benefits here, they're both mathematical and psychological. I mean, yes, on paper, it systematically lowers your average cost per share over time, which is great. But maybe even more important is that it takes your emotion and your ego completely out of the equation. You're not trying to be a hero, you're not trying to pick the absolute bottom or sell at the absolute top. Instead, you're turning market volatility, the very thing that terrifies most people, into your single biggest advantage. And really, that's the choice we all have. You can play the game on the left, this high-stress, high-wire act of trying to guess what the market's going to do next. Good luck with that. Or you can choose the path on the right, a calm, disciplined, systematic process of just building your wealth over time. This isn't about outsmarting the market. It's about outdisciplining it. And this brings us right back around full circle to the entire philosophy of Berkshire Hathaway. This strategy perfectly reflects what Charlie Munger preached his whole life. You don't have to swing at every single pitch. You build your position systematically, you stay disciplined, and you wait patiently for the world to offer you that one truly great opportunity. For most of us, that systematic building, that is the most powerful tool we have. So, we'll leave you with this one last thought to chew on. In an age that is absolutely obsessed with speed, with hype, with constant action, maybe the single greatest advantage an investor can have is just simple, disciplined patience. Thanks for digging into this with us.